Real estate syndications. This type of investment can be an excellent way to continue growing your wealth, utilizing tax benefits, and building equity through real estate without the need to pick up phone calls from tenants or deal with ongoing maintenance. Specifically, they can open the door to huge investment opportunities that would otherwise be too expensive, too risky, or take too much time for you to reach on your own. You may have heard of the term before, but what exactly is a real estate syndication, and how do you invest in one? Hi everyone, this is Brandon with Cosign Equity, a property management company based out here in Southern California, and in this video we're going to go over the basics of real estate syndications, what they are, how they're set up, how to get involved, and how they differ from other types of real estate investments. By the end of this video, you will have a better understanding of how they can help you expand your wealth, and you'll be ready to start searching for your first investment. So let's jump into it. First of all, what is a real estate syndication? In short, a real estate syndication is when a group of accredited or sophisticated investors, and we'll explain what exactly that means in a minute, pools their money together to purchase a large property. Essentially, it's a type of crowdfunding for the real estate industry, and it can be particularly helpful when obtaining traditional funding through a bank is met with too many underwriting requirements or would simply eat too much into your profits. Every real estate syndication deal will be different, but being a part of one can allow you to invest in larger projects such as large multifamily apartment complexes, mobile home parks, industrial parks, self-storage facilities, hospital and medical facilities, and hotels. Sometimes a syndication will buy vacant land and build from the ground up, while other times the asset will be an existing project with a promising upside in either rental income or appreciation. A syndication also offers professional management of the asset, which might not otherwise be economically feasible for a single small investor. Now, as mentioned before, these opportunities are, by law, only available to accredited or sophisticated investors. As seen on investor.gov, which is an official government website of the SEC, in order to be classified as an accredited investor, you must have a net worth of at least $1 million, excluding your primary residence, an income of over $200,000 individually, or $300,000 with a spouse or partner in each of the prior 2 years, as well as a reasonable expectation for the same income in the current year, or a general securities representative license, Series 7, a private securities offering representative license, Series 82, or have a licensed investment advisor representative designation, Series 65. All of this, the SEC says, is to ensure that all participating investors are financially sophisticated and able to fend for themselves or sustain the risk of loss. Now, this same website describes a sophisticated person as one that has sufficient knowledge and experience in financial and business matters to evaluate the merits and risks of the prospective investment. So now that we have a basic idea of what a real estate syndication is, how is it set up and what role will you play? Now, the actual form of the syndication will typically be set up as either a limited liability company, or LLC, or a limited partnership. And the two key components of any real estate syndication are the syndicators and the passive investors. Syndicators, otherwise known as sponsors, are responsible for structuring and operating the deal. They will be the one with the business plan that seeks out investors, looks for a promising investment, does the due diligence to see if it makes economic sense, negotiates with the seller, and arranges financing for the purchase. They will also be the ones to ultimately manage and operate the property once it's acquired, or they will be the ones to work hand in hand with the chosen property management team. If the property is eventually sold, they will also be the ones to navigate that process. Ultimately, their role is to execute the business plan and to deliver strong returns to the passive investors, which we'll describe next. As the name suggests, the passive investors in a real estate syndication are not directly involved with the day-to-day management of the asset. Instead, their value comes from the capital that they provide in order to acquire the property. In exchange, the passive investors will receive ownership shares of the property and have the opportunity to enjoy the passive income that the property produces. This usually happens in the form of monthly or quarterly income distributions. They can also benefit from the equity, appreciation, and tax benefits of owning the property, as well as any returns made upon selling it. As mentioned before, syndication deals typically have two different structures. A limited partnership, in which the sponsor will function as the general partner and the investors will be the limited partners, or a limited liability company or LLC, in which case the sponsor is known as the Class A member and the individual investors are known as Class B members. Now, no two deals are the same, so the specifics of how the sponsor structures that syndication will determine details like how long investors' money will be locked into the deal, the breakdown of equity between each investor, and the timelines or schedule for distributing the funds. Okay, so how do you get involved with real estate syndications? Generally, there are two ways. First, you can rely on your own personal network, such as family, friends, and professional contacts, and start building relationships or attending events with like-minded investors. Many syndication deals are put together through word of mouth and pre-existing relationships, with a sponsor being someone who already has investment and experience in the real estate industry and simply wants to bring others aboard. You can also take a more modern approach and utilize online crowdfunding platforms. Now, although there are convenient websites that you can find online, we still recommend that you reach out to trusted individuals within your network. If you'd like to know more, you can always ask us by following the link that we've put down below in the description. As a professional property and asset management company, Coastline Equity has been helping and advising clients on their real estate investments for over 40 years, and so we think that there are definitely ways in which we can help. Not only with the day-to-day operations and maintenance of their buildings, but also the asset management and financial health of their investments as well. Lastly, we want to take a moment to talk about the difference between real estate syndications and a similar form of investment that you may have heard of called real estate investment trusts. Both provide investors with a way to pool their money together in order to invest in deals and assets that would have otherwise been too costly to procure on their own, but there are some key differences. First, syndications. Syndications are made between private individuals to invest directly into a property within a single deal. They often give investors more direct control and say in the handling of the investment, and they allow all investors to benefit from the tax benefits, such as depreciation pass-throughs and offsetting other forms of income on their tax returns. On the other hand, real estate investment trusts, or REITs as they're commonly referred to, are often publicly traded companies that invest in a variety of deals. In that sense, REITs are more like stocks, where investors buy and own shares in that REIT company rather than the property itself. Once their money is invested, a fund manager can move it as they see fit across a wide variety of projects. Investors have little to no input into management decisions or what assets the REIT purchases. Also, since investing in a REIT is an investment in a company rather than directly into a property, investors won't be able to take advantage of the same tax benefits that a syndication can offer. But despite some of the downsides, REITs may have a lower barrier to entry because it's possible to own fractional shares nowadays, meaning that you could invest for as little as $1 rather than the huge sums needed to even consider a real estate syndication. So if you've been wanting to grow your wealth exponentially by getting involved in larger real estate projects, but just haven't yet had the access to the substantial amounts of capital that are necessary, a real estate syndication may be a great investment vehicle to consider. Whether you prefer to spearhead a future project or play more of a passive role and simply benefit from someone else's expertise, syndication deals can offer tremendous upside and access to new opportunities. As always, thank you so much for watching. If you've gotten any value out of this video, please consider supporting our growing channel by liking and subscribing. If you have any questions or comments, you can also feel free to reach out to us in the comment section down below or through our website at coastlineequity.net. Until then, from all of us here at Coastline Equity, thank you again, and we'll see you next time.